Imagine checking your portfolio this morning. That sinking feeling in your stomach as you scroll through a sea of red. Tech stocks tumbling, growth names bleeding out, and the market indices struggling to stay afloat. The QQQ down 2.67%. SCHG plummeting 4.68%. XLK dropping 5.94%. And semiconductor stocks like the SMH crashing nearly 8% in just 2 months. This isn't just another dip. This is what I'm calling the Great Tech Unwinding of 2025. But here's what fascinates me. While tech investors are tossing and turning at night, dividend investors are sleeping soundly. In fact, some of them are actually smiling at their portfolio returns right now. How is that possible in this market bloodbath? I've discovered something remarkable that's not just surviving this tech sell-off, it's thriving in it. And today, I'm going to show you exactly why I'm not panicking. I'm buying more. Tap that like button and subscribe now to discover how the smartest investors are profiting while others panic. Every market correction tells us a story about human psychology. And what we're seeing right now in 2025 is a chapter we've read many times before. Let me take you back for a moment. February. Historically, the second worst performing month for the S&P 500. This isn't random, it's a pattern that has repeated itself through decades of market cycles. What we're experiencing now, this 5% pullback, isn't the exception. It's the rule. Look at this for perspective. The average year sees at least one 10% correction. We haven't had a full correction in quite some time. So what we're witnessing isn't a reason to panic. It's the market following its natural rhythm. But here's where most investors go wrong. They let emotions drive their decisions. That rush of anxiety when you see your tech stocks dropping. That urge to sell everything and hide in cash. That fear that this time it's different. I call it the fight-or-flight investing trap. And it's exactly why the average investor underperforms the market by nearly 2% every single year. The professionals? They're not panicking. They're not emotional. They're following the data. And the data tells us something fascinating about what's really happening beneath the surface of this sell-off. Here's what most financial news channels won't tell you about this sell-off. It's not the entire market that's in trouble. It's a small group of stocks that have been carrying the entire market on their shoulders. The Magnificent Seven. These 7 tech giants have become the market's addiction. They've created a dangerous illusion of stability while hiding a serious vulnerability in plain sight. Think about this. Just 7 companies, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, make up more than 30% of the entire S&P 500 index. Let that sink in for a moment. When nearly a third of the market's weight rests on just 7 companies, it's not a balanced market. It's a house of cards. And now we're seeing the cards start to wobble. Big money knows this. That's why hedge funds and institutional investors have been quietly reducing their exposure to these Magnificent 7 stocks to the lowest levels we've seen in 2 years. They're not waiting for the collapse. They're moving now, taking their profits and repositioning. It's like watching sophisticated investors quietly heading for the exit while the party is still going. This isn't just data. It's a warning sign. When a market becomes this concentrated, this dependent on a handful of companies, it creates a vulnerability that can affect everyone's portfolio. But within this danger lies opportunity. While everyone else is fixated on the falling tech giants, I've been tracking something remarkable happening with an unsung hero of the investment world. While tech has been stumbling, something extraordinary has been happening with an ETF that rarely makes headlines on CNBC. I'm talking about SCHD, the Schwab U.S. Dividend Equity ETF. Look at this contrast. While the S&P 500 struggles and tech names bleed, SCHD has quietly delivered a total return of 4.5% year-to-date. That's not just beating the market, that's absolutely crushing it in this environment. But this isn't just a lucky streak or a temporary anomaly. What I found next completely changed my investing strategy and made me rethink everything I thought I knew about boring dividend investing. I started digging deeper into SCHD's history, and the data stunned me. Over the past decade, this unassuming ETF has delivered a total return of nearly 192%, averaging almost 20% per year. Let me repeat that. A dividend ETF returning 20% annually over a decade. That's not supposed to happen with safe dividend investments. These are the kinds of returns we expect from growth stocks, but with significantly less volatility and a steady stream of increasing income along the way. What we're witnessing isn't just a temporary rotation from growth to value. It's the market rediscovering the power of quality companies with strong fundamentals during times of uncertainty. SCHD isn't just surviving this tech sell-off, it's thriving in it. And it's revealing something profound about what might be the most powerful strategy for navigating the markets of 2025 and beyond. But the true secret to SCHD's power isn't just in its performance numbers. It's in the unique combination of three critical elements that create what I call the triple crown of dividend investing. What makes SCHD different from every other dividend ETF on the market isn't just one advantage. It's the remarkable combination of three elements that almost never coexist in the same investment. I call this the triple crown of dividend investing. First pillar, capital appreciation. While most dividend investments sacrifice growth for income, SCHD has delivered share price appreciation that rivals many growth funds. We're talking about a nearly 192% return over the past decade. That's not just beating inflation, that's creating real wealth. Think about what this means. A defensive dividend ETF has been outperforming most professional money managers. It's like discovering a Toyota that can outrace a Ferrari. Second pillar, substantial current income. Right now, SCHD offers a dividend yield of 3.48%. In a world where the 10-year Treasury yields less than 4%, this is remarkable. But unlike a bond, this income doesn't come with a fixed payment that erodes with inflation. Instead, it leads us to the third and most powerful pillar, exceptional dividend growth. Over the past 5 years, SCHD has increased its dividend payouts at an astonishing rate of nearly 12% annually. Let that sink in. While inflation has been eating away at your purchasing power, SCHD holders have been getting raises that outpace inflation by more than double. This is the wealth-building formula most investors never discover. It's why someone who invested $10,000 in SCHD a decade ago isn't just sitting on nearly $30,000 today. They've also watched their annual income stream grow from around $350 to over $1,000 per year. And all of this extraordinary performance comes from a methodology so disciplined, so systematic, that it almost seems like financial alchemy. But there's no magic here, just brilliant engineering that's hidden in plain sight. What most investors never see is the elegant architecture that powers SCHD's remarkable performance. This isn't just another random collection of dividend stocks. It's a precision-engineered portfolio built on 4 non-negotiable pillars. Think of SCHD like a high-performance engine, with each component meticulously selected for a specific purpose. First, the foundation. SCHD only invests in companies with at least 10 consecutive years of dividend payments. This immediately filters out fair-weather dividend payers who cut at the first sign of trouble. Second, it screens for quality using metrics like return on equity, cash flow to debt ratios, and dividend growth rates. These aren't arbitrary metrics. They're proven indicators of business excellence that have survived decades of market cycles. Third, it rebalances and reconstitutes annually, ruthlessly cutting companies that no longer meet its exacting standards and adding new ones that do. There's no emotional attachment, no favorites, just disciplined execution of a proven formula. And finally, SCHD constructs its portfolio to create natural diversification across critical sectors. When we look under the hood, we find a strategic allocation that serves as a perfect complement to tech-heavy portfolios. Financials lead the way, followed by healthcare, consumer staples, energy, and then, and only then, a carefully curated selection of technology names. This isn't accidental. It's strategic positioning that creates stability during market turbulence. The top holdings read like a who's who of corporate excellence. AbbVie, Coca-Cola, Amgen, Cisco Systems, Pfizer, Verizon, Texas Instruments, Bristol Myers, Chevron, and PepsiCo. In total, 102 positions, with the top 10 making up about 42% of the portfolio. But what makes SCHD truly exceptional isn't just what's in it today, it's how it evolves. And right now, we're approaching what I call the Great Rebalancing, a critical moment that happens just once a year and could reshape the ETF in fascinating ways. Mark your calendars for the third Friday in March, what I call SCHD Season Finale Day. This isn't just another routine rebalancing. It's the day when SCHD's algorithm makes its annual judgment on which companies stay, which ones go, and which new contenders earn their place in this elite portfolio. Think of it as the investment world's most objective talent show, where only the highest quality dividend payers make the cut, and this year's reconstitution might be one of the most intriguing in recent memory. My analysis, along with insights from SCHD experts like SCHD Stan, who's done a brilliant deep dive into the methodology, suggests we could see some fascinating changes. Among the potential newcomers, MasterCard MC might be making its triumphant return to the portfolio. Exxon and Johnson & Johnson could be joining the ranks as well. And at current valuations, Target looks like a strong contender for inclusion. But here's where the drama unfolds. For every new addition, something has to go. The algorithm shows no mercy, no favoritism. It's cold, calculating, and brutally effective. Home Depot might be on the chopping block, despite its impressive dividend growth record. Unlike last year when we lost Broadcom, a personal favorite, most of the potential departures don't trigger the same emotional response. But here's what makes this annual reconstitution so powerful. It forces SCHD to adapt, to evolve, to stay aligned with changing market realities. There's no fund manager stubbornly holding on to past winners or personal favorites. Just an algorithm relentlessly pursuing quality. This ruthless discipline is exactly why SCHD has outperformed so many actively managed funds over the years. It's why, despite the upcoming changes, or perhaps because of them, I'm not waiting to buy more shares. Because when I look at what's happening in the market right now, I see more than just a tech sell-off. I see a profound shift that brings us full circle to where we began. Remember that sinking feeling I described at the beginning? That anxiety when you check your portfolio and see nothing but red? Now imagine a different scenario. Imagine checking your portfolio in the midst of this tech sell-off and seeing something green and growing. Imagine receiving dividend payments that actually increased while everyone else was panicking. Imagine sleeping soundly through market turbulence because you built your portfolio on bedrock instead of sand. This isn't fantasy. This is exactly what SCHD investors are experiencing right now in 2025. The moral of this story isn't just that diversification matters. We all know that. The deeper truth is that diversification isn't just about protection. It's about opportunity. It's about positioning yourself to thrive, regardless of which way the market winds blow. The tech giants had their moment in the sun. For years, they delivered extraordinary returns and reshaped our world. But markets don't move in straight lines. They move in cycles. And knowing how to navigate these cycles is what separates successful investors from the crowd. That's why I'm not just holding SCHD through this sell-off. I'm actively buying more. Because when I look at the combination of current income, consistent growth, and quality businesses trading at reasonable valuations, I see something more valuable than any high-flying tech stock. I see sustainability. So here's my question to you. Are you already an SCHD investor? When was the last time you added to your position in this remarkable ETF? Let me know in the comments below. I read every single one, and I'm fascinated to hear about your experience with dividend investing during this market turbulence. If you found value in this analysis, do me a favor and hit that like button. It helps other investors discover this content and join our community of thoughtful, long-term investors who are sleeping well in 2025 while others are tossing and turning. And if you're new here, subscribe to join us for next month's deep dive into the SCHD reconstitution results. We'll analyze every addition and deletion and what it means for the future of this extraordinary ETF. This isn't just about surviving market volatility. It's about thriving through it. And with SCHD as part of your foundation, you'll be well positioned to do exactly that. Thanks for investing your time with me today. This content is for educational purposes only. Always conduct your own research and consult with a financial advisor before making any investment decisions. Past performance does not guarantee future results. Thanks for watching, and I'll see you in the next analysis.